Hello traders, Chris Capri, Second Skies Trading. So new trading video for you here. How to trade with dynamic support and resistance using price action and indicators. So about a month ago, about 4 or 5 weeks ago, I did a video on how to trade with support and resistance, 5 key tips, and I will leave a link to that in the description. It's important to understand that support and resistance, there are two major types, and generally when people are talking about support and resistance, the most commonly referred to version or type that they're talking about is what we call static support and resistance. So these are horizontal lines, it could be like 110 or 109 or something like that, and you've seen it on charts, the top of a range or bottom range. But those are lines that are static. They're not moving and they're not evolving. And the market has generally two types of support and resistance, and that's the static type we talked about before, and that's dynamic. And there are various types of dynamic or moving support and resistance that evolves with the market. And it's super important you understand these types because they're going to give you a unique perspective into the markets, the trading, the price action, and also present you with trading opportunities and also entries and exits that aren't going to be necessarily available when you're just looking at static support and resistance. So it's a super important topic. Support and resistance is a critical topic in trading. It's one of the most important skills you could have. And the ability to be able to kind of expand upon this skill or go deeper into it brings you into dynamic support and resistance. And that's the focus of today's video. So we're going to talk about one particular method that I use for dynamic support and resistance. We're going to talk about some key tips for trading dynamic support and resistance. We're going to talk about how you can combine these with other methodologies, things to avoid, and then we'll kind of recap and close here. So let's go ahead and jump into this. So as I've talked about, there are two major types, static and dynamic. Static is horizontal support and resistance levels. This could also be a channel. If you've seen, a channel or what I call a corrective structure or a range. These are static. It's where the support and resistance is not moving vertically up or down. It's just, hey, here's the top, here's the bottom. There are various types of dynamic support and resistance. There is the 20 MA, which is going to be the focus of this particular video. There are sloping channels, so channels that have a relatively clean structure in terms of a bottom and a top, and the lines are moving kind of parallel, so those are sloping channels and they can move up or down. Ichimoku cloud, something that I'm very familiar with. It's something I've been trading for 18 years now. And that has various forms of dynamic support and resistance. And then also VWAP, which is for trading stocks. And so that's a very key indicator, particularly for day trading, but it can also be used for swing trading. There are modified versions of it. But VWAP is an essential stock trading dynamic support and resistance that you have to understand if you're going to trade stocks successfully. For today's video, we're going to be focusing on the 20 MA. And while we are going to be concentrating on forex, just to let you know, this methodology and this approach to dynamic support and resistance using the 20 MA works in commodities, stocks, global indices, everything across the board. Any sort of technical chart and any sort of instrument that you can be trading besides forex, it works. So don't just think this is a forex only. This also works on stocks, commodities, global indices. I use it across every asset class that I trade. Okay, so we're going to get into some key tips, and then we're going to start looking at charts to kind of dive into these particular key points. And so it's super important that you kind of remember these because these are going to be underlying points or themes when you are really learning to use dynamic support and resistance. So the first one we're going to talk about is markets tend to revert to the mean. And so if you look at statistics in stocks or forex or commodities, you can see commonly that when markets get too far away from value, they're going to revert back to value. They're going to revert to the mean. And so just if you start to think about this in your head, the fact that markets are going to revert back to the mean, that should automatically start kind of spawning ideas and strategies and potential trade opportunities that you can use this piece of information, and that's trading to the 20 EMA, and that's trading from the 20 EMA. It's a little more advanced than this particular video, but I want you to just kind of start to think about this. So this is one key tip. The next one is that in deep trends, dynamic support and resistance, particularly in this case, the 20 EMA, tends to hold. So when you have really strong trends to the upside or the downside, the market will tend to stay above in a bull trend at the 20 EMA, and it will tend to stay below it in a strong bear trend. And we're going to show you some charts to look at this here. The third key point is that when you are using dynamic support and resistance, that you never want to trade them in isolation. You want to combine them with other strategies or other trade signals. So other support and resistance levels, breakout structures. There are many things that you can trade this with. So let's go ahead and jump into the first of these key points. Markets tend to revert to the mean. Okay, so we are looking at the daily chart on the pound yen. We're going to actually be in FX. We're going to be focusing a lot on the pound today, but we're going to be looking at some stocks and other instruments. And so this blue line right here, this represents the 20 EMA. And what you can see is that, here the market is trending, but it eventually is going to find its way back to the 20 EMA. The market will never, ever, ever pull away from the 20 EMA and never revert back. That's never happened in history. It's not going to happen. It's mathematically impossible. What this means then is that you need to understand that when the markets get too far away from the 20 EMA, it starts to increase the likelihood that it's going to revert back. And you can often see this most in parabolic moves. So for example, when the market kind of just gets super extended or super sharp moves, it's kind of holding the 20 EMA, holding the 20 EMA, holding the 20 EMA. But then we have an incredibly strong move away from the 20 EMA. Let's zoom into this. Just a super big down move. And look what happens. The market snaps back towards the 20 EMA. And you're going to see this again and again and again and again. If you look at a lot of charts and you look for parabolic moves or markets where they're already trending in one particular direction, in this case bearish, but then it has a really big move away from the 20 EMA, the markets are going to snap back to that. And it's super important. Another key tip that, I kind of didn't mention, but is kind of hidden inside this whole relationship with the 20 EMA is that for the market to be able to keep distance from the 20 EMA, that has to mathematically represent a lot of momentum or strength. So if you look at it here, the market is just, it's a very strong bull trend, but it just keeps its distance away from the 20 EMA for quite a long period of time. That indicates high momentum. Whereas if you look at it here, it's below the 20 EMA, but it's continually pressing against it and coming back, pressing against it, coming back, pressing against it, coming back, pressing against it, coming back. So this would be classified as not as strong momentum. It's still bearish momentum, but it doesn't compare to the momentum in this case where the market has separated from the 20 EMA. So the stronger the separation, the stronger the momentum. That's how the mathematics of the 20 EMA work out. And the longer it maintains this, well, then that just kind of is communicating that you're in a high momentum move here. And only once it starts to revert back to the mean does this market start to really kind of reverse course. And so it's important to understand distance from the 20 EMA creates or communicates strong momentum. The longer it's doing that, the greater the chance it will eventually revert back. But until that kind of reversion happens, you are trading in a strong momentum move. This is not the time to be shorting. You don't just want to be shorting arbitrarily any points along this way when it's showing that, hey, there's massive distance from the 20 EMA. That's high momentum. Just looking at the price action in relationship to the 20 EMA can communicate a lot. It can communicate, okay, we have a high momentum move here. It's been maintained this for a long period of time. I don't want to be shorting at this point in time until I sort of see some sort of change in relationship between this high momentum and distance from the 20 EMA and the market pulling back to it. Until that happens, I don't really want to be looking at shorting opportunities because I'd be trading against strong momentum. Here is a little bit different. The momentum is still bearish, but it's not as strong as it is in terms of the distance from here. You can learn to read momentum just by looking at the relationship of the price action in relationship to the 20 EMA. This is super important. But getting back to the point, markets will tend to revert back to the mean. It gets out of alignment, reverts back to the mean. Gets out of alignment, reverts back to the mean. Gets out of alignment, reverts back to the mean. So this is super important, and it should start to, as you start to really kind of spend time observing this pattern over and over and over again, it should start to kind of create ideas in your mind in terms of possibilities for trading, either trading reverting back to the mean, or what happens when the market does hit that. Can you trade from that? Just start to think about that in your mind. Let that kind of idea spawn and percolate, all kinds of ideas about how this can create trading opportunities for you. And if you do this through looking at charts and charts over and over again, you'll start to come up with ideas as your brain starts to assimilate all these patterns. Okay, so getting to the second point now. In deep trends, dynamic support and resistance tends to hold. So let's go back to the charts. Okay, so let's look at pound Swiss. And here we are. Maximize that. What do you see in this kind of huge bearish trend from the pound Swiss? 134 roughly down to 116, some of the all-time lows. You can see, first we see, based on our prior points, that we have high momentum. It just reverts back and it sells off, and it reverts back and it sells off, and it reverts back and it sells off, and it reverts back and it sells off. And so you can see in deep trends, the dynamic support and resistance, in this case the 20 MA, will tend to hold. And only once it starts to kind of really break this relationship do we have some sort of transition in play. As long as, let's just say you are trading this during this time period, and this is the right edge of your chart. Let's just say this is the right edge of your chart. Okay, well, as long as we're below the 20 MA and we've held for such a long period of time, do we want to be thinking buying opportunities when it's been holding below for so long? No, we want to be thinking selling opportunities. It's not that we can't trade long opportunities, but because we're trading counter trend, we have to realize that this is by default trading against the dominant order flow in the market, and thus a lower probability trade. So what does this mean? Hey, we're below the 20 MA for a long period of time. Until that relationship changes, we want to be looking to sell this as much as possible. If you're going to trade this 100 times in this time period here, you should be trading about 90% of this on the sell side, and only in very picky opportunities should you be looking at this on the buy side. In deep trends, dynamic support and resistance tends to hold, and we don't want to be trading against this if we have these kind of long structures in play until that changes. And so once we see that the dynamic has changed, then we can start considering other side of the market or two-way opportunities. And you can see this as we look back. Here we can see we have a long period above it. We have a long period below it, a couple touches on that. You can just see many times that when we're in these deep trends, that was the SMB move. But when you're in these deep trends, that tends to hold. And we can see this on multiple time frames. It's been holding on the daily time frame between May, so until much recently, until end or middle of August. So if you look at that time period on, say, a 4-hour time frame, hey, look at this most recent one. Deep trend to the downside, it holds, it holds, it holds, it holds. The market starts to change the relationship with it, and the market starts to reverse. And so again, you can see this over and over again. Here, it's hugging it a little more, so it's not quite a strong momentum move, but it's holding because we're in a strong trend. So super important to understand that as long as we're holding that relationship, we want to be trading with that side of the market as much as possible. And the stronger the trend, the greater the chances that this is going to hold. Only once the price action starts to change its relationship with the 20 MA and the dynamic support or resistance, that's when we need to be thinking transition. That doesn't mean trend reversal, but it means that the underlying dynamics that in terms of the order flow that we're supporting a deep trend are changing, and thus it changes the opportunities available to us as traders. The third point that I'd like to talk about here is when we're using dynamic support and resistance, in this case the 20 MA, we want to combine it with other strategies and other signals. We never want to use this in isolation. I am always combining my dynamic support and resistance with price action. And there are some tips and there's some basic things that you can combine it with that you can start practicing on your own to enhance or amplify any particular trading signal. So you can combine the 20 MA with support and resistance levels. You can combine it with breakout structures. There's a lot of things you could be combining it with that will help kind of enhance or amplify any particular trading signal because you have more pieces of information supporting your trade idea. So let's get into some charts on this. So pound Swiss, it's been in a bear trend for quite a long time. Most recently started to create some change in the bear trend. It's now got kind of more of a two-way side to the market. On a short-term basis, it is bullish, but while in this bear trend, I kind of want to show you something here. We talked about combining it with breakout structures. Now, if you had watched one of my most recent videos, and let's zoom into this, we had talked about it's called the one pattern for trading breakouts, and we talk about the different kind of key variables you're looking for in the price action to help you find or discover potential breakouts that are either about to happen or have happened and how you can trade that. One of the things we talked about was that we need a clearly defined support or resistance level, and it has to have two touches on that. And we want to be trading this with trend as much as possible. So we're in a bear trend and we kind of bottom out support, create a nice reaction, and the market comes right back to that level, a few pips past it, creates another bounce off of that. And so what happens, it comes back to that same level and creates a weaker bounce. And when we start to get weaker bounces off a particular support and resistance level, that's telling us that the bulls defending this level aren't able to push back as much. You know, keep in mind here they push back from 2350 to it's about 2447, so about 100 pips. Same pushback, they actually push back even more, about 140 pips. But then look what happens here. They push back only about 60 pips. And then we come right back to it and they're only able to push about 40 pips off of this. So the weakening reactions and bounces off this support is communicating to us two things. One, it's suggesting that the bulls have less capacity or force to defend this level. If they had the same amount of support, they had the same amount of order flow, the same amount of volume, then they would be able to at least maintain the bounces off this in terms of distance from it. But it's a weaker bounce. It's a weaker bounce. You compare it to this one here. This is 100, 140. But now we're getting into 50, 60. Now we're getting into 30, 40 pip bounces. Those are weaker bounces. That means less capacity to defend that level. That also means that the bears are taking over. They are taking the punches from the bulls and they're punching back harder each time. And that is communicating to us a potential breakout is happening here. If you look at what happens, you can see how the bounces were getting well above the 20 MA, gets well above the 20 MA, gets well above the 20 MA, gets above the 20 MA. Now all of a sudden the 20 MA is kind of holding as resistance. So the 20 MA is now combining with the price action to act as resistance. And this is very helpful. If this was to bounce here and just have a super weak bounce and just hold on the 20 MA, that would be showing us the dynamic, in this case, dynamic resistance is capping the price action. And so the bulls are getting squeezed out of the market and a breakout is likely to happen. And look what happens to this, that the market comes right back to it, just touches it to the pip, sells off. And so this is, we're now combining the 20 MA, we're combining dynamic support and resistance to amplify a particular trade signal for us. Super, super important. Let's look at another example, one that I'm actually watching right now, AGIO Pharmaceuticals. Let's kind of zoom out first. So AGIO, zoom back a little bit, hit a major support. And support's held since 2015, late 2015, early 2016 here at about 34.11. It literally went to it. And it's the first time we visited it since, I think it was early 2016. So the first time we visited in about 3.5 years. And the market hits it, short false break, and bounces off of it. Right now it's currently capped at the dynamic resistance, in this case the 20 MA on the daily time frame. But what I'm looking at when I look at multiple time frames, and I think this bounce is legitimate. I think it's going to bounce a little bit more. I'm anticipating that this is going to probably bounce more towards 48, possibly into the 55, and maybe if we get a really good bounce into the 60s. So assuming that this support is going to hold and that there are strong buyers, and we can see that there's strong buyers here. We've had 3 days of very strong bullish momentum, closes near the highs. The market opened, found intraday support, and has climbed up again. So looking at this on a smaller time frame, we can see here's that resistance. The market comes up to it, and you can see here's the swing low. So it's support, market bounces, just breaks past it. Then what does it do? Breakout pullback setup to this. Here, let's do the line just to make it easier. Make it super clear. So sells off, support, bounces, and it just slices right through it. Super short pullback into was support, now resistance, sells off. And then now very strong buying off the mid 32s. Super strong. This is an hourly chart. We've only had a few bearish candles, and it's been almost all bullish. And when we hit this former support, now resistance again, and we do get a pretty good sell-off here. We get but it's only an hour reaction. And look what happens after the strong selling. The bulls come right back in, are pressing against this. If we look at this on a 5-minute time frame, we can see that here's that 1 hour sell-off. But the bulls are going after it again. And then there's a weak reaction off it, and they're just continually squeezing against the bears here. So I'm suspecting that if we can get above 38.67, maybe we hit it one more time and we have a weak reaction. But if the reaction off it is pretty weak and it finds support off the 20 MA, so 20 MA continues like this, and the market pulls the 20 MA and then continues to squeeze higher and higher, then I'm anticipating a break, and I think that's a really good breakout trade there. It offers a really good risk to reward on this one here. So combining it with other types of signals, various support and resistance, breakout structures, there's many ways you could combine it, but this is just to give you a couple examples of how I use it. So now that we've gone over those key points, I do want to mention time frames. You can have the kind of a general framework in terms of how to use the 20 MA in multiple time frames. If you're doing intraday trading, whether it's stocks or commodities or FX or global indices, it doesn't matter. My preferred intraday time frames are the 1 hour and 5 minute. I do also trade the 1 and 3 minute, particularly when I'm doing day trading of stocks. But in terms of trading FX or in trade of anything, if you want a general framework or general time frames for trading intraday, 1 hour and 5 minute are my preferred. For swing trading time frames, I like the 4 hour and daily charts. You can also throw in the 1 hour. The 1 hour is kind of this time frame that's kind of in between. It can be used for day trading. It's a great kind of higher time frame context for day trading, but it also has the capacity to kind of double up as a swing trading time frame. It's the lowest of them of what I would consider a swing trading time frame, but it can be used as a swing trading time frame. And so you can use the 1 hour, 4 hour daily charts for that. If you're position trading, you're holding trades for weeks, months, maybe a year or two, you're trying to capture really big moves, then you can use the 20 MA on the weekly and the monthly charts. You could also throw in the daily, but the daily would kind of be like the smaller time frame. It would be the lowest of them. Position trading, you're generally holding for long periods of time. And so I'd recommend the weekly and the monthly charts. Well, that's pretty much it. That wraps up this lesson. I am now back. I was traveling the last week or so to Chicago to see my mom. It was her 84th birthday. And the brothers and I kind of came into town to help her buy her last car. She feels like this is the last car she's ever going to get. So we wanted to help her with it, as she's not really, that best at car buying. And she needed our help and with finance and everything like that. So we flew into town for her birthday and helped her get her last car. It was kind of a very interesting moment for us all to be there and to just help her with this process. So with that being said, make sure you Hulk smash the like button and subscribe to our channel. It really helps us out with the YouTube algorithm, and it allows us to keep doing videos like this, giving out free content, really rich free content to y'all, and to help you all with your trading process. Make sure to leave your comments and feedback below in terms of what other videos you would like subjects on. Other than that, I look forward to hearing from your feedback and comments on this. Enjoy the video and the strategies and the lessons taught in here, and I'll see you in the next video. Take care, everyone.